Greg Abella over at Investment Partners Asset Management. You like business development companies. Now, they've struggled over the past year. A lot of them are trading below their net asset values. Why do you like them?
I like them for their forward yield. I like them for their discount to net asset value. I'm a fan of them because they trade at low multiples of their earnings. It's an out-of-favor sector with a lot of unloved companies, and as a value guy, that appeals to me.
All right, well, one BDC that you like is Prospect Capital. Pays a really nice yield, 14%. Actually beat Wall Street expectations about 2 or 3 weeks ago, and that gave the stock a little bit of a pop, but it's been down significantly since last year. Why do you like this one in particular?
I like it because of the yield that you mentioned. Also, there's been a lot of insider buying, and that lends some credence to the story. I also like it for its low multiple of earnings. I think that over time, it's a great total return story, and even though it's had its time in the tank, over a long period of time, they've been a good performer, and they're one of the larger ones.
Well, another way you can invest in BDCs is through an ETF, just to keep going with the acronyms, and that one is the BiZD. This is a market vectors ETF, and it owns a lot of names like Ares, American Capital. Pays a nice 10% yield. It's diversified. Still, it owns a lot of problem children in there. So tell me why you like it.
Well, it's weighted by market cap, so you're sort of getting a mixed bag, but skewed towards the larger ones. And the sector, as you mentioned, has been out of favor. It's unloved, but that's generally the time that you want to average in to a sector like that. And again, a total return story. You're getting some income plus potential for capital appreciation over a long period of time. You can't maybe make a whole portfolio out of just this, but as part of a fixed income sleeve, it fits a good niche.
Well, another way you can gain some yield is through call override funds. And there's 2 ETFs that you like, one of them which is a NASDAQ dynamic override fund. This is the triple QX, and the other one is the Nuveen S&P Buy Right Income Fund. This is the BXMX. They're down with the market, but they also pay a nice yield.
They do pay a nice yield. The benefit of having covered calls as a strategy, obviously, is not just the income, but it dampens downside portfolio risk. So if you want access to the equity markets, and you're maybe not convinced they're going to perform over the next 5 years the way they've performed in the last 5 years, this is a good way to maybe modulate some of the risk, participate, but also get some income from the call premium.
All right. Well, thanks a lot, Greg Abella.
Thank you so much.
And thank you for watching The Street.